Have you ever, picked up a company's financial report and just felt completely lost? Like, where do I even start? Is this reliable? What am I actually looking at here?
Mhm.
Well, today we're going to cut through some of that confusion. We're doing a deep dive into something that, okay, it might sound incredibly dense, but it's really the cornerstone of financial trust,
Mhm.
the audit opinion.
Exactly. And these aren't just dusty documents for accountants tucked away somewhere. They are absolutely critical. They're the lens that investors, lenders, even, potential employees use to gauge a company's real financial health, its integrity.
Kind of like the independent referee.
That's a great way to put it. The independent ref in the sometimes very complex game of corporate finance.
Okay. So our mission today is basically to demystify one very specific kind of audit opinion. It's called the unmodified opinion, or
Hmm.
sometimes unqualified. Think of it as the gold standard. It's the auditor's stamp of approval, essentially. And we've got some really clear, um, really detailed sources lined up that lay out exactly what's in these reports, why every little piece matters, and how auditors get to that point.
Hmm.
So our goal for this deep dive, it's maybe a bit ambitious, but I think we can nail it. By the end of this, you won't just understand what unmodified means. You'll appreciate the whole rigorous process behind it.
Yeah.
You get what auditors are really saying.
And crucially, what they're not saying, that's important too.
Exactly what they're not saying. We're going to break down every key section, make it super easy to follow so you can walk away feeling, confident, really well informed next time you see one of these vital documents.
It's like a plan.
Okay, let's dive in then. Let's unpack the world of audit opinions. The core of financial trust. What is an unmodified, unqualified audit opinion? All right, so let's start right at the beginning. Set the stage. What exactly is an audit in this context? Why do companies even bother going through this whole process? It sounds, frankly, expensive and time-consuming.
It definitely can be both of those things, yeah.
And then once they do it, why is this specific type of opinion, the unmodified or unqualified, why is that seen as like the absolute gold standard?
That's the perfect place to start. So fundamentally, an audit is an independent check, an examination of a company's financial statements.
By an outsider.
By an impartial third party, yes. And the main point isn't just, ticking and tying numbers. It's really about providing assurance. Assurance that those financial statements, they give a true and fair picture of the company's financial position. It's all about building trust.
Okay, trust. Makes sense.
And that unmodified or unqualified opinion, that's the best possible outcome. It's the auditor basically saying, look, in our professional judgment, these financial statements are presented fairly in all material respects according to the right rules, like U.S. GAAP, for instance. That opinion is a critical signal to anyone looking at those statements, investors, banks, whoever, that they can generally rely on them.
Okay, you use that phrase, fairly, in all material respects. That sounds really, really important. Can we break that down a bit? What does fairly actually mean here? And what's material? How do they decide that?
Absolutely. That phrase is like the heart of the opinion. So when we say fairly, we don't mean absolute 100% perfection, not every single number exact to the penny.
Right.
What it means is that the financial statements give a true and accurate picture of the company's situation. There aren't any significant distortions or misleading bits of information. Think of it like a really good photograph, a high-resolution photo. It captures the essence of the thing, right? Shows all the important details accurately. It might not show every single tiny speck of dust, but it gives you the full, reliable picture you need.
That's a helpful analogy. So it's the big picture, reliably presented.
Exactly. And then materiality. This is one of the most fundamental concepts in auditing. And honestly, it's often misunderstood.
Okay.
A misstatement could be an error, could be something left out. It's considered material if it's big enough or important enough that it would likely influence the decisions of someone using those financial statements.
So it's about influencing decisions.
Precisely. An auditor isn't hunting for every tiny $5 mistake in a huge company. That's not material, right? No reasonable investor is changing their mind over $5.
Right, of course.
But, a misstatement involving millions, or maybe misclassifying debt in a way that totally changes how the company's leverage looks, that would definitely be material. So auditors focus their energy, their testing, on those significant areas.
Okay, that clarifies a lot. So materiality isn't just size, it's impact.
Its impact on a reasonable user's decision, yes.
So why should I, as a listener, why should I care so much if a company gets this thumbs up, this unmodified opinion? What's the real world effect?
Oh, yeah, the effect is huge. It ripples through almost everything in finance. For, say, individual investors like you, it's a massive signal of confidence.
Okay.
If you're thinking of buying stock, seeing that unqualified opinion tells you an independent pro has gone through their books and found them reliable, imagine investing without that. It'd be pure guesswork, almost, based on trust alone. And, well, history shows us that doesn't always work out.
No kidding.
And for banks, lenders, it's absolutely critical. They need assurance that the company they're lending millions to actually has the assets, the cash flow, the earnings it says it does.
Makes sense. They need to know they'll get paid back.
Exactly. This opinion gives them that assurance. It directly impacts whether a company can even get a loan and on what terms. And it goes beyond that. Suppliers, customers, even potential employees look at this. It builds trust in the company's whole public face. It signals they're transparent, accountable.
So it underpins the whole system, really.
It really does. Imagine if companies could just make up numbers. No independent check. The whole financial system would just seize up. This audit opinion, it's a fundamental pillar holding up that trust.
Right. Okay, here's where you mentioned it gets a bit tricky with the words. We've been saying unmodified and unqualified, sometimes using them together. Are they exactly the same thing? Or is there a difference we should know about?
That's a fantastic question. And yeah, it's a nuance, but it points to the different regulatory worlds these companies live in.
Ah, okay.
So historically, unqualified was kind of the main term everyone used for the best audit opinion. Clean bill of health, but auditing standards have evolved, globally. So now unmodified is the term you'll typically see used for non-issuers.
Non-issuers, meaning?
Private companies generally, companies not listed on major stock exchanges, their audits usually follow generally accepted auditing standards, or GAS. That's set by the AICPA, the American Institute of CPAs.
Okay, so unmodified private companies, it will GAS.
Mostly, yes. Then unqualified is the term that's stuck around for issuers.
Issuers being public companies.
Exactly. Public companies traded on exchanges like the NYSE or NASDAQ. Their audits are under the microscope of the Public Company Accounting Oversight Board, the PCAOB.
PCAOB.
Right.
Heard of them.
Yeah, they set their own, often stricter, auditing standards for these public companies. So here's the key takeaway. Both words, unmodified and unqualified, they mean the exact same positive thing about the financial statements.
Okay.
They both mean presented fairly in all material respects. But the specific word used, unmodified or unqualified, it just tells you a little bit about the company's regulatory environment, whether it's a private company under GAS or a public one under the PCAOB.
Gotcha. So it's a subtle clue about who's overseeing the audit.
Precisely. A little marker for those in the know. 2, decoding the non-issuer report, the unmodified opinion for private companies.
Okay, that makes total sense. Knowing that difference helps frame things. So now let's actually get into the weeds. Let's look at what you'd actually see in one of these reports, section by section. Maybe, to make it easier, let's start with the parts that are pretty much the same in all clean audit reports, whether they're called unmodified or unqualified. And then we can zoom in on what's unique to each type.
Excellent idea. Yeah, the vast majority of the content is very similar, which definitely helps understand the core principles. So, okay, imagine you've got an audit report in front of you. A. Basic elements of the unmodified audit opinion, common to most reports. The very first thing you'll see right at the top is the title. It'll say something like Independent Auditor's Report.
And that word independent is important, you said.
Critically important. It's not just decoration. It's the bedrock of the auditor's credibility. It means they have no conflicts of interest, no financial ties, no management role, nothing that could sway their judgment about the company they're auditing.
Okay.
This objectivity, it's everything. It ensures the opinion is unbiased, trustworthy. Think about it like the referee analogy again. If the ref owned shares in one team, would you trust their calls?
No way. Not at all.
Exactly. Same idea here. Without independence, the whole audit is basically pointless. It could lead to huge scandals, erode public trust. We've seen that happen.
Yeah, definitely. So they're independent. Who are they reporting to? Who gets this report?
Good question. That leads us right to the next bit. The addressee. This just says who the report is directed to. It could be the board of directors, maybe management, maybe the shareholders, sometimes a specific committee. Depends on the specific job, the engagement.
Now, why does that matter? Who it's addressed to?
It clarifies who the auditor is primarily accountable to for that specific audit. For private companies, you often see it addressed to the owners or the board. Reinforces that the report is for those in charge of governance.
Okay. Then what? What's the main event?
Then you get to the opinion section. This is it. This is the headline, like you said, the big conclusion.
Right.
It clearly states the name of the company whose financials were audited, no confusion about who we're talking about, and it includes a direct statement. These financial statements have been audited, confirms the process happened.
Okay.
It then lists out exactly which financial statements were covered. Usually, the balance sheet, income statement, cash flow statement, statement of changes in equity. And it specifies the dates or the periods covered by each one. So the scope is crystal clear.
And the notes. Do they mention the notes? Because those can be long.
Yes, absolutely. Crucially, it references the notes to the financial statements, reminds the reader those notes are integral. They contain vital details, explanations about accounting policies, assumptions, potential risks, stuff that explains the numbers. You really have to read the notes, too.
Good point. Don't skip the notes.
Definitely not. And then, here's the core sentence. In our opinion, the accompanying financial statements present fairly, in all material respects, the financial position, as of the date, and the results of operations and cash flows for the period.
That's the magic phrase again?
That's the one, the auditor's formal conclusion. Clear, concise. And right after that, it identifies the accounting rules they used, usually US GAAP or maybe IFRS internationally, and mentions the country of origin, so everyone knows the playbook they were following, vital for comparing companies.
Okay, so opinion section is the verdict. Got it. Then there's another section, basis for opinion. What's that telling us? Is it just legal stuff? Or is it about how they reach the verdict?
Much more than just legal stuff. The basis for opinion section is super important because it explains how the auditor got to that opinion. It gives you transparency into the process.
Okay.
It states clearly that the audit was done according to generally accepted auditing standards, GAAP, and it specifies the U.S. as the origin for those standards. That sets the professional bar, the quality framework for the whole audit.
Right, GAS.
It also points you to another part of the report, which we'll get to, describing the auditor's responsibilities under GAS. And critically, it repeats that the auditor has to be independent and meet all the ethical requirements.
Reinforcing that independence point.
Absolutely. It's not just a one-off mention. It's a constant theme. It's a public promise of objectivity. And finally, this section includes a statement that the auditor believes the evidence they gathered was sufficient and appropriate.
Sufficient and appropriate, what does that mean exactly?
Good distinction. Sufficient is about quantity. Did they get enough evidence? Appropriate is about quality. And relevance, was the evidence reliable? Did it actually relate to what they were testing? So basically they're saying, we got enough good information to back up our conclusion.
Okay, enough good evidence. Makes sense. What comes after that?
Next up, you usually find the section on responsibilities of management for the financial statements. This is really key because it draws a clear line in the sand, tells the reader who's responsible for what.
Separating the roles.
Exactly. It states very clearly. Management is primarily responsible for preparing the financial statements and making sure they're presented fairly. This is fundamental. Auditors don't create the financials, management does.
Right. Auditors check them.
Correct. And management's responsibility also includes designing, implementing, and maintaining good internal controls.
Okay, hold on. Internal controls. What exactly are those? Why is management responsible? And what if the controls are bad? What happens then?
Great questions. Internal controls are basically the company's own systems and procedures. They're designed to make sure financial data is recorded accurately, assets are protected, operations run efficiently, and they follow the rules.
Like needing 2 signatures on a big check, that kind of thing.
Exactly like that. Or separating duties so one person can't, say, approve and pay an invoice all by themselves. Or doing regular bank reconciliations. They're the safeguards built into the company's daily routines.
Okay, safeguards. Got it.
And management's responsibility here is huge because strong controls are the first defense against mistakes or fraud, material misstatement, as the report says. Good controls reduce the risk of bad numbers before the auditor even shows up.
So if controls are weak.
If controls are weak, the risk of significant errors or fraud shoots way up. It makes the auditor's job much harder, often needing way more testing, which costs more time and money. It's like inspecting a house built on a shaky foundation. The inspector has to dig a lot deeper.
Okay, that makes sense.
This section also mentions management's job in assessing going concern. That's evaluating if there are any big problems that raise doubt about whether the company can actually stay in business for the next year or so. So yeah, this whole section clearly separates management's duties from the auditor's, sets expectations.
Right, so after management's responsibilities, we get to the auditor's side.
Exactly. The next section is auditor's responsibilities for the audit of the financial statements. This spells out in detail what the auditor actually does. Their main goal, it says, is to get reasonable assurance.
Reasonable assurance, we talked about that briefly, not absolute.
Precisely. Reasonable assurance that the financial statements, taken as a whole, don't have any material misstatements, whether from simple errors or deliberate fraud. And of course, their responsibility is to issue the report with their opinion.
Okay, reasonable versus absolute. That feels like a really important distinction. Why isn't it absolute? Does that mean there's still a big risk left over for me as an investor?
You've nailed a critical point. Reasonable assurance is a high level of confidence, but no, it's not absolute. It's not a guarantee.
Right.
Even a perfectly planned and executed audit following all the GIACE rules might not detect every single material misstatement. There are just inherent limits.
Like what?
Well, things like the nature of audit evidence itself. Often it's persuasive, not definitive proof. You look at samples, not every single transaction. There's also judgment involved. And you have to balance the cost of the audit with the benefit you can't audit infinitely. Plus, fraud can be really cleverly hidden. Collusion, forgery.
Right, people trying to cheat the system.
Exactly. So think of it like that detailed weather forecast analogy we used. It's based on tons of data, sophisticated models, best science available, gives you high confidence.
But not a guarantee it won't rain.
Exactly, not a crystal ball. An audit gives robust assurance, high confidence, but those inherent limits mean it's not 100% perfect. Auditors use rigorous methods and professional skepticism, a questioning mind, to minimize that risk as much as possible. Reasonable assurance is the gold standard for independent checks.
Okay, that helps put reasonable in perspective. High confidence, not perfection.
Right. And here's something that surprises people. The risk of not catching fraud is actually higher than the risk of not catching an error.
Really? Why's that?
Because fraud is deliberate. It often involves active concealment, people working together, faking documents, intentionally leaving things out, lying, overriding controls that are supposed to stop them. That's just inherently harder to uncover than an honest mistake.
Wow. Okay. That's sobering but important to know.
It is. The report also revisits materiality here from the auditor's viewpoint. Misstatements matter if there's a substantial chance they'd influence a reasonable user's judgment based on those financials.
Right.
And this section gets practical. It says auditors use professional judgment, maintain professional skepticism, that questioning attitude. They assess the risks of material misstatement from error or fraud. And then they design their audit tests specifically to address those risks. They examine evidence, often on a test basis.
So they don't check every single transaction?
Generally, no, not for large companies. It's usually based on sampling and risk assessment. They also get an understanding of the company's internal controls.
Can we say management is responsible for controls?
Yes, management designs and implements them. The auditor understands them, primarily to figure out what audit procedures they need to perform, how much testing, where to focus. But, and this is a really important nuance unless they're specifically hired for it, auditors are not giving an opinion on how effective those internal controls actually are.
Oh, okay. They understand them to plan their work, not to certify the controls themselves.
Exactly. That's a separate engagement, often required for public companies, which we'll get to. They also evaluate the accounting policies the company chose, check if management's estimates seem reasonable, and look at the overall presentation of the financials. And they have to conclude if there's substantial doubt about the company continuing as a going concern.
Right. Staying in business.
Finally, this section mentions communication. Auditors have to talk with those charged with governance, usually the audit committee or the board. They discuss the audit plan, the timing, any significant findings, any problems with internal controls they noticed. Keeps the people at the top in the loop.
Okay, so that's a pretty comprehensive description of the auditor's job. What about other information? That sounds a bit vague.
Yeah, the other information, when relevant section, can seem a bit odd at first. It basically refers to stuff included in, say, an annual report that is not part of the actual audited financial statements.
Like the CEO's rah-rah letter to shareholders. Or maybe a description of new products.
Exactly that kind of thing. Management is responsible for that other information. The auditor's opinion explicitly does not cover it. They give no assurance on it whatsoever.
So the auditor doesn't give their stamp of approval on the CEO's letter, even if it's printed right next to the financials. Do they just ignore it then?
Not quite ignore it. They don't audit it. True. But they do have a responsibility to read it.
Why read it if they're not auditing it?
To check for major inconsistencies. Does the CEO's letter say something that flat out contradicts the audited numbers? Or does anything in that other information just look materially wrong based on what the auditor learned during the audit?
Ah, okay. A basic sanity check against the financials.
Pretty much. If they find a material inconsistency or a potential misstatement in that other info and the company won't fix it, the auditor has to describe the problem in their audit report. So no audit, but a read-through for red flags.
Got it. Then there's other reporting responsibilities. Does that come up often?
Sometimes. The other reporting responsibilities section pops up if the auditor has extra duties required by law or regulation beyond just the standard GAS audit. Maybe specific industry requirements or rules in a particular country. If it's needed, it gets its own section, usually titled something like Report on Other Legal and Regulatory Responsibilities, and it comes after the main audit report sections.
Okay. And finally, the signature and date.
Right. The signature of the auditor, auditor's address, and date of the auditor's report. The signature is the audit firm's name, not the individual partner usually. The address is just the city and state where they issued the report.
And the date. Is that important?
Very important. The date of the auditor's report is the date they finished their fieldwork and got all the evidence they needed. It signifies they have sufficient appropriate evidence to support their opinion, and management has taken responsibility for the prepared financial statements.
So it's like the cutoff date for their responsibility.
Essentially, yes. It's the date up to which they considered events and transactions. If something major happens after that date, generally, the auditor isn't required to update their report for it unless specific circumstances arise, which is less common for a standard unmodified opinion. B, unique elements of the unmodified audit opinion. Non-issuers.
Okay, so that covers the big common pieces. Now, let's zoom in on what's unique to the unmodified opinion for those non-issuers, the private companies. You mentioned something called key audit matters, or COMs. What are those about? And why are they only optional if the main opinion is already clean?
That's a great question. Key audit matters, CAMs, are part of a trend towards more transparency, even for private companies, although it's optional for them.
Okay.
CAMs are defined as those things the auditor already talked about with the company's governance body, the board or audit committee, that in the auditor's professional judgment were the most significant things they dealt with during that specific audit.
Most significant, like
Well,
the hardest parts.
Often, yeah. The most complex, the riskiest, the ones requiring the most judgment. Private companies have the option to hire their auditor to identify and report these CAMs.
Why would they pay extra for that?
They might do it if they want to give extra insight to specific people using their financials, maybe sophisticated lenders or private equity investors or other key stakeholders who'd appreciate knowing where the big audit challenges were. It adds credibility.
Okay, so how does the auditor decide what's a CAM?
They look for areas that needed significant auditor attention. Typically, this means areas with higher assessed risk of material misstatement, or areas involving really significant judgment calls by both management and the auditor. Think complex estimates like valuing unique assets or future liability.
Right, the fuzzy areas.
Exactly. Or significant, unusual transactions during a year, a big merger, a major restructuring. It boils down to the auditor's professional judgment based on that specific audit.
And if they do report CAMs, what does that look like in the report?
There's a separate section titled Key Audit Matters. It starts with some boilerplate language saying, basically, we address these issues as part of our overall audit, and we're not giving separate opinions on just these matters.
Okay, important clarification.
Very. Then, for each CAM they identified, the report has to do three things. 1, reference any related disclosures in the financial statements so you can find the underlying info. 2, explain why this matter was considered so significant in the audit. And 3, describe how the auditor addressed it. What procedures did they do? What was their approach?
Wow, that sounds really insightful, like getting a peek behind the audit curtain.
It absolutely is. It provides valuable context on the toughest parts of the job for that particular company.
Okay, that transparency sounds great.
Yeah.
Are there times when they wouldn't report CAMs, even if there were tough areas, besides the company just not opting for it?
Yes. A couple of important caveats. If a matter actually leads to a modified opinion, like a qualified opinion, because something is materially wrong or they couldn't get enough evidence.
So not a clean opinion.
Right. Or if there's substantial doubt about the company's ability to continue as a going concern. Those serious issues are not put in the CAM section. They get their own prominent treatment elsewhere in the report, like in the main opinion section or a special going concern paragraph. You don't want CAMs to distract from or dilute a more serious warning.
Makes sense. Don't bury the bad news.
Exactly. Also, auditors generally can't report CAMs if they issue an adverse opinion saying the financials are not fairly presented, or if they disclaim an opinion, meaning they couldn't form an opinion at all, unless, some specific law requires it. And of course, they have to document everything, why they picked certain CAMs or why they decided there weren't any, see audits in accordance with two sets of standards.
Mhm.
And just quickly, sometimes a non-issuer needs an audit under GS, but also under another set of standards.
Like if they operate internationally.
Precisely. Maybe they need to comply with international standards on auditing ISAs, or maybe they're voluntarily getting a PCAOB standard audit, perhaps if they're thinking about going public later. If that happens, the basis for opinion section just gets updated to say the audit followed both sets of standards, like GAS and ISAs. Full disclosure of the rules they played by. 3, navigating the issuer report. The unqualified opinion for public companies.
All right, perfect. Now let's pivot. Let's talk about the public companies, the issuers. The goal is the same, right? Assurance on the financials. But you mentioned their reports have some key differences because of that extra public oversight, the PCAOB. What are the main things listeners should look out for in an unqualified report for an issuer?
That's a crucial shift, yeah. The core goal is the same fair presentation reliability. But the PCAOB rules definitely add some distinct, often tougher requirements for public company audit reports. Let's hit those key differences. A, key differences in report elements from non-issuers. First off, the title. For an issuer, it must say, Report of Independent Registered Public Accounting Firm.
Ah, registered public. That's new.
Yep. That registered public bit explicitly signals the firm is registered with, and therefore overseen by, the PCAOB. It flags that extra layer of regulatory scrutiny that comes with being a public company auditor.
Okay. What about who it's addressed to?
The addressee is also different and quite specific for issuers. The report is almost always addressed to the shareholders and the board of directors.
Not management.
Generally not management. Addressing it directly to the owners, the shareholders, and their main oversight group, the board, really emphasizes who the auditor is ultimately accountable to. It boosts transparency for the investing public. It says, this report is for your benefit, the owners and governors, not just the people running the company day to day.
Interesting distinction. Accountability to the top.
Exactly. Then the basis for opinion section has slightly different wording too. It explicitly states the firm is registered with the PCAOB and is required to be independent according to U.S. federal securities laws, SEC rules, and PCAOB rules.
So even more emphasis on independence and the specific regulators.
Definitely. It highlights the specific, stringent independence rules for public company auditors, some of the toughest anywhere. It then states the audit was done according to PCAOB standards, which, like GAS, require planning and performing the audit to get reasonable assurance about material misstatements. It describes the process assessing risks, testing evidence, evaluating estimates and policies, looking at the overall presentation, and concludes the audit provides a reasonable basis for the opinion. B, critical audit matters, CAMs, mandatory for issuers.
Okay, now for the big one you flagged earlier, CAMs, critical audit matters. Unlike the optional CAMs for private companies, these are mandatory for public ones, right? So what exactly are they, and why the mandate? What's the big deal here?
You're right to focus on CAMs. They're a huge deal in public company audits, a major transparency initiative from recent years. A CAM is defined as something the auditor communicated or had to communicate to the company's audit committee that meets two conditions.
Okay, what are the conditions?
1, it has to relate to accounts or disclosures that are material to the financial statements. And 2, it involved especially challenging, subjective, or complex auditor judgment.
Challenging, subjective, or complex judgment. That sounds intense.
It is. It's basically pointing to the hardest parts of the audit, the areas that really stretch the auditor's professional judgment, and it's generally expected that most public company audits will have at least one CAM. Big, complex companies usually have complex areas requiring significant judgment.
So how do they decide what meets that bar, especially challenging?
The auditor considers several factors. High-risk areas they identify, that's a big one. Areas where management made really significant judgments or estimates, like valuing weird financial instruments or predicting future warranty claims.
Yeah, those always seem tricky.
Definitely. Big, unusual transactions, complex mergers, major impairments, those often qualify. Also, how subjective were the audit procedures themselves? Did they need highly specialized skills or knowledge, maybe bring in specialists? It's about identifying where the auditors really had to dig deep, apply serious expertise, and make some tough calls.
Okay. And reporting them is mandatory. How does that look?
There's a whole separate section titled Critical Audit Matters. It starts with introductory language similar to CAMS, making it clear that discussing CAMS doesn't change the overall opinion on the financials, and they aren't giving separate opinions on the CAMS themselves.
Right. Insight, not a modified opinion.
Exactly. Then, for each CAM they identify, the report has to spell out what the CAM is, what the main reasons were that led the auditor to consider it a CAM, why was it so challenging or complex, how the auditor addressed it in the audit, what work did they do, and finally, a reference back to the relevant accounts or disclosures in the financial statements.
Wow. That gives investors a ton of detail about the tricky spots, like what kept the auditors busy.
Precisely. It's unprecedented insight into the most difficult, subjective areas of the audit.
What if somehow a company truly has no areas that meet that challenging, subjective, complex definition? Seems unlikely for a big public company, but...
Even then, the report still has to include the critical audit matters section. It would just contain a statement saying something like, we determine that there are no critical audit matters.
So the section is always there, even if it's empty. Ensures consistency.
Correct. And there are rules about the language used. Auditors can't use wording that sounds like they're trying to dodge responsibility or downplay the significance of the CAMs or their overall opinion. Got to keep that accountability clear.
Makes sense.
Also, generally, auditors aren't supposed to reveal new, non-public company information when describing a CAM unless it's absolutely necessary to explain why it was a CAM or how they audited it. It's a balance between transparency and protecting sensitive company info.
Okay. Are there any public companies that don't have to report CAMs?
Yes, there are specific exceptions. Brokers and dealers reporting under a specific SEC rule, certain types of investment companies, employee benefit plans, and, importantly, emerging growth companies are exempt.
Okay. So smaller, newer public companies might not have them yet.
Correct. But for most established public companies, CAMs are a standard required part of the audit report now. And just like with CAMs, auditors have to document why they decided something was or wasn't a CAM. See signature, tenure, location, report date, issuer specifics. The end of the issuer report also has the signature, tenure, location, and report date. Like non-issuers, you get the audit firm's signature, the city, state, or country it was issued from, and the report date, signifying when the fieldwork wrapped up.
Okay. But you mentioned tenure. What's that?
Yes, tenure. This is unique to issuers and very important. The report must include a statement saying the year the audit firm began serving consecutively as the company's auditor.
How long have they been on the job?
Exactly. How many years in a row they've been the auditor. This was a big transparency push by the PCAOB. It lets investors see immediately how long the relationship has been going.
And why does that matter?
Well, there are debates about long auditor tenure. Some argue a fresh perspective is good periodically. Others value the deep knowledge built over years. Regardless, disclosing the tenure allows users to consider that information themselves when evaluating the audit and the auditor's independence. A 20-year relationship might raise different questions than a 3-year one, even though the independence rules apply equally.
Interesting. Okay, one more issuer-specific thing. Management reports on internal control over financial reporting. You touched on this.
Right. This is a huge part of the public company world, largely thanks to the Sarbanes-Oxley Act. Many, especially larger public companies, are required to have what's called an integrated audit.
Integrated meaning?
Meaning the auditor performs 2 audits and issues 2 opinions in one interconnected process. One opinion on the financial statements, which we've been discussing, and a second, separate opinion on the effectiveness of the company's internal control over financial reporting.
So for these companies, the auditor does certify the controls.
Yes, they provide an opinion on whether management's assessment of internal control effectiveness is fairly stated, and whether the controls themselves were effective as of the balance sheet date. It's a significant extra layer of assurance for investors, focusing directly on those internal safeguards we discussed earlier.
Okay, but what if a public company has to report on its controls, but the auditor doesn't do that second audit? Maybe it's a smaller public company that's exempt from the internal control audit requirement. How do they make sure people don't get confused and think the controls were audited?
Excellent point. Clarity is key there. If management is required to report on internal controls, as most issuers are, but the auditor was not hired to perform an audit of those controls, no integrated audit, then the auditor has to add specific language to their report.
Where does that go?
Usually in the basis for opinion section. It will explicitly state that the company wasn't required to have an integrated audit, or that the auditor wasn't engaged to audit the internal controls, and therefore the auditor is expressing no opinion on the effectiveness of internal control over financial reporting.
Okay, so a clear disclaimer to avoid any misunderstanding.
Exactly. It manages expectations and ensures users know precisely what the auditor did and did not provide an opinion on. For note, the people behind the report, audit participants and transparency.
Okay, so we've dissected the report itself, but you mentioned there's another layer of transparency, especially for public companies, about who actually did the work. Like knowing the chef behind the meal, you said.
Yeah.
How did this work?
That's a great analogy, yeah, because accountability matters. For issuers, this extra transparency comes mainly through something called Form AP.
Form AP, what's that?
It's a specific form that the audit firm must file publicly with the PCAOB for every audit report they issue for a public company. Yeah. The whole point is to disclose key details about the specific audit engagement and the people involved.
Okay, what kind of details?
Several key things. The name of the audit firm, obviously. The name of the public company client. The date of the audit report. And this was a big change a few years ago, the name of the engagement partner.
The actual individual partner in charge.
Yes, the lead partner responsible for signing off on the audit for the most recent period. Their name and their unique ID number go on this public form. It was a major move towards individual accountability.
Wow, okay. What else is on Form AP?
It also shows the city and state or country of the audit firm office that issued the report. It says whether the report was dual dated, meaning it has a second date for a specific later event, and it discloses whether other accounting firms participated in the audit.
Like if it's a global company with subsidiaries audited by different firms locally.
Exactly. Form AP indicates if other firms were involved and whether the main auditor took responsibility for their work or if responsibility was divided. This level of detail gives investors and regulators a much clearer picture of who did what, and Form AP has to be filed pretty quickly, usually within 35 days after the audit report first hits the SEC, or even faster, 10 days if it's part of a registration statement. So the info gets out there promptly.
So Form AP is the mandatory filing. But can auditors put any of this info in the actual audit report too?
They can, yes. These are optional inclusions in the audit report. While Form AP is required, the audit firm can choose to include some of that same info directly in the report itself.
Like the engagement partner's name?
Exactly. They can put the partner's full name right there in the report. They can also include details about those other participating firms. They might state that they supervise the other firms and take responsibility for their work according to PCAOB standards. They could even disclose the percentage of total audit hours performed by those other firms.
So adding that detail right into the report itself, even though it's also on Form AP, what's the benefit of doing that for stakeholders? Why the option?
Well, the benefit is immediacy and convenience, really. It puts that transparency front and center for anyone reading the report without needing to go look up Form AP.
Right.
It gives a fuller picture right away of the audit team structure, the lead partner, the reliance on other auditors, especially for big multinationals. Some argue it enhances investor confidence even further by showing the firm is being extra open about who did the work and how responsibility was shared. It's all about reinforcing that public trust.
Wow. Okay. I feel like we've genuinely gone from needing that decoder ring to having a pretty crystal clear map of these audit reports now. We've covered the key differences, right? Unmodified for non-issuers under GOs, unqualified for issuers under the PCAOB. We've hit comms versus the mandatory comms. But that common thread, that powerful statement, runs through both. Fairly presented in all material respects. That's the key takeaway, isn't it?
Absolutely. If that unmodified or unqualified opinion, it's a really strong signal of reliability. But, like we stressed, it's not that guarantee of perfection.
Right. Reasonable assurance.
Reasonable assurance. It comes from a tough, detailed process. Lots of professional judgment, lots of skepticism, tons of evidence gathering. It's the auditors basically saying, look, we did the work, we followed the strict rules, and based on that, this company's financial story, it checks out as they've presented it.
So what does this all mean for you listening right now? Well, the next time you see an audit report, hopefully you won't just see, a dense, intimidating document. You'll see it as proof of a deep, structured analysis, something designed to give you confidence in that company's financial story. It's not just bean counting. It's this whole ethical, regulated process aimed squarely at building and maintaining trust in our financial markets. Trust that lets everything else happen, from investing to lending to hiring.
Well said.
So here's a final thought to leave you with. Given all this detail, all the judgment, the immense trust placed in these opinions, Think about things beyond just buying stocks. Think about your pension fund, maybe, or the mortgage rates banks offer, or even just the viability of your favorite local shop that needs loans to operate. What surprising everyday decisions or systems do you think are quietly relying on the trustworthiness of these audit opinions, maybe in ways you hadn't even realized before?